What if the Federal Reserve's next big move could trigger the biggest crypto boom we've ever seen? In this video, we're diving into the brewing possibility of 2025 rate cuts and how they might spark a powerful crypto supercycle. We'll connect the dots between traditional finance, market psychology, and emerging blockchain trends, all explained in a clear, fact-based, and conversational style. Stay tuned, because by the end, you'll have a sharper edge on how the landscape is shaping up and why it could matter more than ever. Let's jump right into it. The Fed's next move: rate cuts on deck. The Federal Reserve is poised to shift from aggressive tightening to rate cuts by 2025, responding to cooling inflation and signs of economic slowdown. This pivot will mark a major inflection point in financial markets. Historically, lower interest rates stimulate borrowing, spending, and investment, creating fertile ground for risk assets like crypto to thrive. After several years of monetary tightening, market participants are eager for liquidity to return. Early signals suggest the Fed could aim for gradual cuts to avoid reigniting inflation, but even mild easing could unlock massive capital flows. Crypto markets are already positioning for a future where money is once again cheap and abundant. Why lower rates matter more than you think. Lower interest rates don't just make mortgages cheaper. They fundamentally shift how investors allocate capital across all asset classes. When traditional safe havens like bonds yield less, investors naturally look toward higher risk, higher reward opportunities, and crypto fits that profile perfectly. Cryptocurrencies offer outsized return potential in environments where cash and bonds underperform. Add to that the increasing integration of crypto into mainstream finance, and you have a perfect storm brewing. Rate cuts act as an accelerant, making risk assets more attractive and giving speculative sectors the fuel they need to rally hard and fast when market sentiment flips bullish. Crypto's reaction to past Fed pivots. History shows that crypto tends to respond dramatically when monetary policy shifts toward easing. After the 2020 rate cuts, Bitcoin surged from under $10,000 to over $60,000 in less than a year, dragging the entire crypto market upward with it. Liquidity-driven rallies are a hallmark of crypto cycles, as cheap money fuels speculation, innovation, and rapid adoption. Even during less aggressive pivots, digital assets have typically outperformed traditional equities. This pattern suggests that a 2025 easing cycle could light the match once again, especially if combined with growing institutional participation and broader global adoption trends already taking shape. The macro cocktail: inflation, recession, and risk appetite. The broader economic landscape plays a critical role in how crypto markets react to monetary shifts. In 2025, expectations are pointing toward a cooling inflation environment, mild recession risks, and renewed appetite for higher-risk investments. If inflation stays tame while growth recovers, the Fed will have room to cut rates without immediate fear of overheating the economy. This sweet spot, low inflation, moderate growth, and cheap money, historically triggers strong bull runs across risk assets, with crypto often leading the pack. Investors are watching closely because the macro cocktail brewing today could set up the biggest opportunity window since 2020. Institutional capital, ready to flood in. Institutional investors are sitting on record levels of dry powder, and many are already dipping their toes into crypto. With yields on bonds expected to fall post-rate cuts, institutions will face mounting pressure to seek alternative sources of return. Bitcoin ETFs, regulated custody solutions, and clearer regulatory frameworks are lowering traditional barriers. In a low-yield world, crypto's asymmetric upside looks increasingly appealing to pension funds, hedge funds, and asset managers. A large-scale reallocation of even a small fraction of institutional capital toward crypto could create a demand shock powerful enough to fuel a true supercycle in digital assets. Retail FOMO 2.0. Will it be different this time? Retail investors have historically played a crucial role in every crypto bull run, with the 2025 environment likely favoring risk assets. Another wave of retail FOMO, fear of missing out, seems almost inevitable. New on-ramps, from simplified apps to mainstream brokerages offering crypto, make it easier than ever for the average person to participate. Lessons learned from past cycles might lead to a more cautious, informed retail audience, But the psychological driver of wanting to catch the next big wave remains potent. When both retail and institutions align, the momentum can snowball rapidly, igniting parabolic price action. Spot ETFs, blockchain adoption, and catalysts lined up. Multiple catalysts are already lined up to complement the potential monetary tailwinds. Spot Bitcoin ETFs are gaining traction, opening the doors for traditional investors. Blockchain adoption across industries like finance, gaming, and artificial intelligence integration is accelerating. Layer 2 scaling solutions are making crypto more usable and cost-effective. These factors combine to create a structural foundation for sustained growth, not just speculative bursts. If rate cuts provide the spark, these underlying advancements could provide the fuel to sustain a true supercycle rather than another short-lived rally. The market is maturing, and the timing could be eerily perfect. Not just Bitcoin, altcoin boom, and Layer 2 explosion. While Bitcoin often leads, history shows that altcoins and Layer 2 solutions outperform dramatically during euphoric stages of a bull cycle. Ethereum, Solana, Polygon, and newer blockchain innovations are poised to capture outsized gains if liquidity floods back into the system. Sectors like decentralized finance, real-world asset tokenization, artificial intelligence-powered platforms, and gaming ecosystems could see explosive growth. Investors are increasingly sophisticated, seeking utility and innovation beyond simple speculation. This broader market maturity could lead to a richer, more diverse boom, one where quality projects gain real traction while opportunistic traders chase high-flying smaller-cap coins. Risks to watch: regulatory shocks, fake-outs, and volatility. Even if the setup looks perfect, risks remain high. Regulatory crackdowns, especially from major economies like the United States or Europe, could derail momentum overnight. Market structure remains fragmented, prone to manipulation and sudden liquidity crunches. Fake-outs, where markets briefly rally before collapsing, are common, especially in a highly speculative environment. Volatility cuts both ways. Massive gains are possible, but so are brutal corrections. Investors must stay grounded, conduct due diligence, and manage risk proactively. The path to a supercycle is never a straight line, and surviving the inevitable turbulence will be as important as riding the wave. Strategy session: how smart investors are positioning right now. Smart investors aren't waiting for the Fed to announce cuts. They're positioning today, accumulating strong assets quietly, diversifying across Bitcoin, Ethereum, and promising altcoins, and staying updated on macro trends are key strategies being deployed. Many are holding higher cash reserves to capitalize on early cycle dips while selectively entering strategic positions. Others are focusing on infrastructure plays, exchanges, custody providers, and blockchain developers that will benefit from broader adoption. Whether building long-term portfolios or trading opportunistically, preparation today could mean massive rewards tomorrow. The crypto supercycle, if it comes, will favor the ready over the reactive. If 2025 truly brings a Fed pivot and a flood of liquidity back into markets, crypto could be the biggest beneficiary of all. We've explored how rate cuts, macro conditions, institutional inflows, and technological progress are setting the stage for what could be a historic run. Thanks for tuning into Nexus Dividends. If you found this breakdown valuable, make sure to like, comment, and subscribe for more sharp, no-fluff insights. Stay curious, stay strategic, and we'll see you in the next one.